Tech stocks have been on fire, jumping 78% in the last 2 years, booming 185% in the last 5, and nearly doubling the market return over the last decade. You have got to be some kind of a moron, I mean a real idiot or something, not to invest in tech stocks. And while I am all that and more, there are some very good reasons why I stopped investing in shares of technology companies. In this video, I'll show you why I'm not buying tech stocks right now, for how long, and why every investor needs a stock rotation strategy. Stick around, and towards the end of the video, I'll reveal what I am buying and 4 stocks to watch right now. Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel, and you know I gotta send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, the run in tech stocks has been amazing, and we've been following that bull market here on the channel. I recommended social platform Snap last September when investors only wanted to talk about Facebook, and shares are up 190% in the last 10 months. Logitech was one of my favorite tech stocks in a December 2019 video and is now up 195%. But one of the biggest mistakes you can make as an investor is thinking that what worked yesterday is going to work tomorrow. This chart from Morningstar ranks the stock sectors by return for each of the last 10 years. You see information technology in light blue here, and that outperformance leading the market for 3 of the past 4 years. But there is more here than just what looks like a Jackson Pollock painting. Tech stocks posted negative returns in 2018 and lagged the market in 4 of the last decade. In fact, stocks in healthcare and consumer discretionary spent more years in the top 3 than tech stocks. You have got to be ready for these kinds of market rotations, for those shifts in investor sentiment around a group of stocks. I'll show you why technology companies could underperform next, but first, I want to personally invite you to get the Daily Bowtie, our daily market newsletter sharing the most important news, strategies, and tips straight to your inbox. It's totally free, just something I like to do for all you out there in the nation, so look for that free sign-up link in the description below. Now, I want to lay out 3 reasons here why tech stocks could underperform over the next couple of years. Then I'm going to show you how to watch for those shifts in stocks so you always stay ahead of the market. And first here, I've taken the forward price-to-earnings ratios from FactSet. So those dark blue bars here are the current price of the stocks in each sector of the S&P 500 divided by the earnings that analysts expect those companies to report over the next year. So this is a forward-looking price-to-earnings ratio. So how expensive are stocks in each sector? We also see the 5-year and the 10-year average of that PE ratio in light blue and green, and I've added the percentage each sector is currently above that long-term average. For example, at the far left, stocks in the consumer discretionary sector are priced at 32.5 times expected earnings, which is 60% more than that long-term average of 20.3 times. Investors are paying a premium of 60% right now on stocks in that sector. And what becomes immediately clear here, just looking at this, is that the market as a whole is very expensive right now. The S&P 500 in the middle here is trading 32% above that long-term PE ratio, and every sector is trading at a premium. But we're talking tech stocks here, so look at the second group from the left, information technology, trading 58% more expensive. Now, tech stocks are the second most expensive sector right now. Now, another reason tech stocks might underperform is everything in that larger macroeconomic environment just seems to be lining up against it. We're seeing a real momentum in government regulation, which could slow the growth in these big tech giants. Higher interest rates is going to mean lower discounted value for those fast-growing stocks, and over the last few years has brought a real change in how we think about globalization. Nations are becoming more protectionist, are passing policies that force more production onshore, and that could slow down the trend that we've seen over the last 3 decades, where technology has really gotten cheaper, progressively cheaper. Now, this next one is a big factor for tech, and one nobody is talking about yet, but it's a function of the difference in COVID vaccination globally. If we look at a comparison of the vaccination data, we see the EU and the United States have about half of their population fully vaccinated, and a little more than that with just at least 1 dose. But many parts of the world are not nearly as far along. Nations in South America have less than a fifth fully vaccinated, and I can tell you that number is actually skewed because of the higher rate in Chile. The actual number is probably less than 10% in most countries in the region. Now, Asia also has less than 1 in 10 people vaccinated, especially in India, where just 1 out of every 15 people have gotten that vaccination. Nation, that is going to be a huge factor in economic growth over the next year and possibly even longer. And what you can do with this is look for stocks of companies that earn more of their revenue domestically, so here in the United States or in Europe, instead of internationally. This is another great chart by FactSet that shows the percentage of revenue stocks in each sector get from within the US and internationally. So if we look to the right here, tech stocks on average generate 57%, more than half of their revenue internationally, more than any other sector. You've also got high dependence on international sales in materials, consumer staples, and communication services. But on the other side of the graph, the stock sectors that depend less on international growth, like utilities, which only collects 3% of total revenue, or real estate and financials, which are both less than about a fifth of their revenue from international business. But really, those three factors aside, all you have to do is look at a chart of tech stocks over the last few years. The chart here of the tech-heavy Nasdaq index shows tech did really well over the 9 years to 2020, and then something happened, something big that just exploded the sector higher. Nation, the returns in tech stocks have been amazing, and I'm not trying to be a negative Nancy, but you cannot look at a chart like that and not think that something broke to make that happen. Something that could reverse and cause a lot of tech investors a lot of pain. So here, I want to show you how to watch for that kind of a shift in the markets, how to build that into your investing strategy. Then I'm going to reveal the stocks I'm buying right now. But first, I want to get your opinion on this too. What is that one investment or the group of stocks you think will underperform over the next few years? Now, I usually ask what stocks you're buying or which ones you're watching, but here I want to know, what are you avoiding? So scroll down and let me know in the comments below. And sometimes watching for that shift in stocks is as easy as just playing contrarian, going against what has worked. If we look at that chart of the sector returns again, what has underperformed over the last few years? Now you've got energy stocks in dead last for 3 of the last 5 years. Healthcare and real estate have also been big underperformers. Now this doesn't mean you have to do this every single year or adjust your portfolio every January 1st. Go ahead and ride out those winners, but don't be afraid to shift when all the factors are lining up against those winning stocks. Another clue is just following the stock returns by sector and watching for that change in leadership. We see here the tech-heavy Nasdaq in red versus the broader S&P 500, and tech has done really well over the last 2 years. But if we look at a year-to-date chart, that strength has clearly broken down, with a broader market beating tech stocks since mid-February. And now this kind of change in leadership is even more important for those stocks that have done so well over the last few years, because a lot of those higher PE ratios that we saw earlier, the investor appetite for these stocks is just based on that leadership. In part, tech stocks have done so well because they've done so well. Investors have seen that momentum in the returns and have rushed in to get theirs, but when other sectors start to outperform, that momentum argument is going to fall apart, and those investors are going to rush to the exits. Now, before I reveal the stocks I'm buying, understand I'm not totally giving up on tech stocks either. You can see a snapshot of my E-Trade account here, and you still see I've got a sizable positions in Salesforce, PayPal, Qualcomm, and 2U Inc. So I'm not suggesting you sell out of tech completely, because there are some great stocks to buy in that sector that can still produce those double-digit returns. I did take some profits in some of those tech stocks that have doubled over the past year, but mostly I'm just using all my new money to buy into other sectors. And one of the sectors I really like now is real estate and real estate investment trusts. Now, all you out there in the nation know, real estate is where I got my start as a commercial property analyst, and there's no asset that has created as much generational wealth. Real estate is now the top performing sector of the year, and stocks are rising on multiple factors. So not only are we seeing a recovery in retail and a lot of those hardest hit property types from the last year, we're also seeing investors rush into real estate as inflation protection. Another reason why I really like real estate stocks here is because I think it's a win-win scenario for investors. This sector has really stable cash flows, so it tends to do well when the rest of the market weakens, when investors look to those safety sectors like utilities, consumer staples, and real estate. But it's also seeming to right now like the stocks in this sector are going to do well if the economy keeps growing, if we continue to see that recovery in commercial property, and as inflation has more investors looking for protection. And 2 examples of stocks I'm watching in REITs include Stag Industrial, ticker STAG, which is benefiting from that boom in warehouse demand around e-commerce packaging, and Medical Properties Trust, ticker MPW, which is really a pure play in that recovery for profitability of hospitals and medical services. Both of these stocks pay a solid dividend above 3.5% and should continue to see higher sales driving share prices. The other sector I really like right now is financials, and specifically the banks. Stocks in the financial sector have fallen lately, underperforming for the last few months, but still posting a 22% return for the year. Now that recent pullback was on lower interest rates, basically making banks less profitable, but I think it's an opportunity here to buy back in for what should be a really good year. Not only will banks get back to profitability with those higher rates, but you've still got lots of loan loss reserves to help them boost earnings, and lending is set to come back as households start spending again. In fact, we're up 58% in shares of both Citigroup and Wells Fargo since adding them to our 2021 Bowtie Nation portfolio late last year, and both still have upside potential left. Wells Fargo, ticker WFC, is set to benefit for all those reasons that are going to help bank stocks in general, but also could jump as it works its way out from under a lot of those Fed rules put in place over the last few years. We could see the dividend here jump back to its old levels and investors rush back in. I also like New York Community Bank Corp, ticker NYCB, here for its 6.2% dividend yield and great valuation. Shares trade for just 0.83 times book value, which is extremely low for a quality bank, and the average analyst target of $15.18 per share is 35% higher than the current price. Click on the video to the right for the 7 penny stocks the pros are buying right now. 7 stocks with potential returns of 50% and higher. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.